Welcome to the Thematic Edge. I'm Marvin Barth of Thematic Markets and Seriously Marvin, and I'm here again with my good friend and co-host from the Global Watchtower, Mark Farrington. And we have a special guest today, one that Mark actually introduced me to and worked with for many years, 30 years ago in Singapore. David Dredge. David, welcome to the program.
Hi, guys. So good to see the both of you.
We're very privileged to have Dave here because Dave is the chief investment officer of Convex Strategies, which is a specialty hedge fund that invests in tail protection. Has been around for 15 years, but Dave, you've been actually an active market participant in managing derivative portfolios for 40 something like that. So you are absolutely the expert to talk about risk and risk mitigation, and how to do so with derivatives, which isn't frankly not for everybody. And I think, an important caveat to issue up front is that everything we're going to be talking about here is for informational purposes only. You should not be using derivatives if you don't know how to use them or attempting to. They are potentially very dangerous, but they are amazing risk mitigation tools in the right hands. And Dave certainly is one of the right hands there. So, with that, um, uh, Dave, welcome to the program. I just want to say one more thing. This is just a little advertisement I have to get out there. Dave, I do have to admit, and this is for full disclosure, just in case I throw any softball questions at you, that you are a subscriber to Thematic Market Research. And in fact, you are on the record as saying that Thematic Market Research is the first and only research that Convex Strategies has ever subscribed to.
Mhm.
So,
That that is, I believe, true. We have a weird opinion here where people who try to forecast the future don't matter, but we actually think you two are pretty useful.
I appreciate that, and I definitely think the same of my colleague Mark here. And I do think this is going to be a really interesting juxtaposition, and I'm going to try and frame our conversation around this because, as you know, Mark and I do try and forecast the future and do try and forecast what are the risks you need to look out for. And you and I have had this discussion in the past before, and I'm sure you've had the same with Mark, where you say, yeah, that's all fine and good, but I don't think anybody can forecast the future. It's interesting to watch you two try that, but I just hang a sign on my door saying I buy vol, and people tell me where the risks are.
I think you both, and I know certainly Mark, who had to put up with me in my much younger, much more cavalier days. But you would both agree that the risk in the system is leverage. It's where is there leverage that has built up, accumulated in excess of the underlying capital to absorb losses in a system. And so, as you say, as opposed to us trying to perceive all the different potential exogenous shocks that exist out there, we sort of singularly focus on the endogenous risk of a building leverage through the volatility supply in the various markets that we see that in. So eventually, if we buy enough convexity in something at incredibly cheap prices, it does kind of start to tell us, well, the risk is probably here.
Yeah.
So, look, I think for us to make this a useful discussion, especially for non-specialists, we're going to have to unpack some of the terms that you just used and describe sort of your worldview and that point about risk. But before I start with that, you've triggered me now. Um, can I push back on your definition of risk? Can I instead suggest that leverage is the magnifier of those risks that makes you need the convexity, and we'll get to what that means, to address it. But the underlying risks are manifold, right? They can be an asteroid striking Earth. They can be, a technological shift. They can be all sorts of different things. That's the actual risk, but where it's going to manifest in its most explosive form in markets is usually associated with underlying leverage. Do you disagree with that, or does that fit within your framework?
No, I mean we sort of we follow the principles of self-organized criticality,
Yes.
and the most common one of those being the concept of forest fires. And so there are any number of things that can start a fire. There can be lightning strikes on this side of the forest, or kids playing with matches on that side of the forest. But in the world of financial markets, the big risk that accumulates in the market is correlation, is the contagion risk. It's the risk that that fire spreads and goes and torches the rest of the forest because of the interconnectivity, which I would define as leverage. And so only one tree catches fire because of the lightning strike. The risk to the system is that that fire spreads from tree to tree to tree through the connectivity of the dry brush. So sort of pair box, self-organized criticality, sandpile theory, fingers of fragility. That's kind of the way we look at the world.
Yeah, there's some really fantastic modeling of particularly forest fires or as you say, stacking grains of sand, things like that. And if you go out there on the internet and look for these things, there's some really wonderful examples of that. But it is about this self-organizing criticality. Let me start in terms of getting some definitions on the board. You often speak of Sharpe World in very critical terms. Can you explain to those who don't know what you're talking about there, or sort of don't understand capital asset pricing models? What is Sharpe World?
So Sharpe World is our sort of umbrella term to capture the the what we would term flawed models and methodology of economics and finance that revolve around the very simplifying assumptions of normal distributions, continuous liquidity. Uh, I wrote it this way in my note when I first described it. In Sharpe World, historical volatilities and correlations always remain constant. Geometric compounding paths are irrelevant. Tails are never fat. Leverage is not risk. Frequency matters more than magnitude. Ensemble averages dominate time averages, and hens lay soft-boiled eggs. And that's really just a take on what Benoit Mandelbrot said, decades and decades ago, basically saying that the whole construct of this of all these Nobel Prize winning theories, the efficient market hypothesis and modern portfolio theory and capital asset pricing model and dynamic stochastic general equilibrium models are all based on these underlying assumptions that only hold true if you assume all those things apply in the real world, which,
Yeah.
again, Mandelbrot 50 years ago proved that they didn't. And oddly, even though everybody's well aware of it, but the system ignores it,
Well,
amazingly.
so I think that is an interesting, and as the economist in the room, I will throw out a small defense of these models in that, look, they are helpful for parameterizing how you think about the interaction of economic variables and asset prices. But to your exact point, you always have to remember the assumptions that underlie them and that they are only as useful in parameterizing that system as the assumptions are valid. And you need to be aware, and I think this is what Mark and I try and do over and over
Yep.
when we are forecasting, is think about where are those assumptions violated and how is that going to break the system. But I think the to your point about the underlying sort of problem in financial markets is that I've called it over quantification. Ian McGilchrist whom I'm pretty sure you're familiar with, has talked about it in terms of left brain versus right brain thinking. It's much simpler to just keep that system and just ignore all the things you can't control or can't forecast because understanding where those assumptions violate is a stochastic process. That is a random process that is really, really difficult. So too much of financial markets have just decided, well, a lot of the time it doesn't matter, so let's just ignore it. I think that's the underlying problem. Do you
Well,
see it differently?
no, I'd see it very much that way, and I coined the term amongst the people uh, who operate inside of Sharpe World. So Sharpe World is a big from central banks and how they try to impact economies through monetary policy and other stuff, and the regulated financial industry and how they treat risk within their roles as financial fiduciaries are all dominated by the Sharpe World methodology. And obviously, we all have much familiarity with market crises, which without fail are where too much leverage is built up in regulated financial institutions because they are adhering to these things and what I have dubbed rational accounting man, because they are not rational economic man. They're not homo economicus because they don't have that information and make decisions over long-term probabilistic blah, blah, blah. They're rational accounting man. They're operating in a 1 year calendar year incentive structure
Exactly.
imposed regulatory wise all these flawed assumptions about normal distributions and stable correlations and stable volatilities. And they go out and expose the system to tail risk with massively undercapitalized exposures because they're following exactly these rules. And that then ends up being precisely where systems topple over and systemic risk arrives and bailouts ensue and the problem gets kicked down the road again. And so that's exactly it. And, I divide the world into rational accounting man, which are those employed within Sharpe World who have no skin in the game and a incentive structure that is, not beholden to actual prudent risk management. And the rest of the world, what I would call boundedly rational agents, after Herb Simon or Gerd Gigerenzer's bounded rationality, are people who are taking the best they can do to evaluate the environment they're operating in, and then completely impeded by computational capacity and foresight, applying decision heuristics to do the best they can, which that is heavily driven by the tacit knowledge and skin in the game of, hey, I don't want to go bankrupt, or, I don't want to do something I can't recover from. Prudent risk management. And that, you'll hear me talk about is the path to good decision making.
Yeah, although I mean, and it is funny. Look, I don't want to derail us here, but it is funny how much these little simple institutional issues perturb that system and
Mhm.
create all sorts of fundamental, not just abrogations of those assumptions that we talked about, but actual maladies. So I remember, I had my own failed hedge fund for a short period. And one of the things that I just thought was really, really crazy is how tax law effectively, and it's everyone's tax law, effectively forces bad behavior.
Yeah.
It forces people to think about their year-end bonus and their year-end performance because you're going to be taxed on that regardless of whether you take it out or not. And as a result, you just talked about people prudently managing wealth. Well, if you're a family office thinking over generations, maybe you can get away with that. But your typical asset manager, third party asset manager that you're going to outsource that to actually faces those tax constraints, which encourages very bad behavior because you can recoup all those wins in 1 year and you don't have to pay back the losses later
Yeah.
if the fund goes out of business,
Yeah,
right?
it's like I said, that's an area where a guy who really should be managing for the capital preservation and growth has slid into a rational accounting man mode and
Exactly.
is operating away from the objective of terminal standings at the end of a multi-year investment cycle.
It is. So let's quickly talk about some of those terms. Well, in within Sharpe rule, I mean, one of the key problems is, as you express it, that risk is synonymous with volatility.
Yeah.
Um, and they're not the same thing. And in fact, there's such thing as good volatility. So could you talk about, you know, what differentiates good volatility from bad volatility, and how that relates to the concept of convexity.
Yeah. Well, I mean, most simply put, I mean, the most I refer to it as the Wittgenstein ruler of Sharpe World is the Sharpe ratio, which measures risk as a unit of volatility without differentiating between upside volatility and downside volatility. So most simply put, upside volatility is good. You want to own things that are going up in large chunks. You want to avoid things that are going down in large chunks. So, a simple way to think about convexity that we talk about all the time is you'd happily trade off more upside volatility for less downside volatility. But the Sharpe ratio tells you to do the exact opposite. The Sharpe ratio is telling you that foregoing upside volatility is a risk reduction. And so the common, in each Sharpe ratio strategy, the common strategy is something with bounded upside. It's covered calls, it's levered carry, it's all the traditional carry strategies, put writing, that says, oh, look, I've reduced my volatility by foregoing the upside and probabilistically reducing the downside, which is, by its very recipe, what creates negatively skewed returns. And so that's just a terrible, terrible form. I mean, obviously, and again, I'll use our race car analogy, right? The guy who wins the multi-lap race is the guy with the best brakes. So the objective is to put good brakes on your car so you can drive faster. It's all about acceleration and deceleration. So you want to be accelerating in good times and decelerating in bad times versus the Sharpe world or Sharpe ratio optimized strategy that's sort of trying to target arithmetic annual returns one lap at a time, assuming the fiduciary starts over equal at the end of each lap and ignores the geometric compounding path through time and ends up just targeting the average lap speed. You know, not noticing that you actually never realize the average. The average is just the average of the divergences from the average, and it's a waste of time. Which comes back again a little bit to the my economic niggle, particularly in Europe, when my friends at Europe tell me that they've set they've got some mythical R star and they've aligned interest rates precisely to average inflation across 20 countries, which by definition means they have the wrong interest rate for all 20 countries because nobody's at the average.
Another whole conversation. But let's go on. I wanna take your race car analogy because it is an excellent one. And living in Chelsea, I see lots of people with Lamborghinis and Austin Martins and just massive engine cars, and then you watch them drive, and they can't even drive these things, right? Um, but this is in many ways exactly what you see, I think, in financial markets, and it
Yeah,
comes from some of those perverse incentives in the Sharpe world that you talked about, where people have a lot of bells and whistles on their portfolio, but then they're not actually taking risk. Like, they're
yeah,
not going down a windy road at full speed because they have the braking capacity to
correct.
slam on those brakes as they go around, go into the turn so they can accelerate out of it. How does that sit with like what you and I'm sorry, I am going to throw a softball at you, setting up your because I think it's important for the rest of our discussion here. How do you think about your ability to put that brake on, and what does that mean for the risk that your clients really should be taking on the other side that they may not be?
Yeah, the first question without fail that I ask in every first meeting with a institutional investor is why aren't you taking more risk?
Yeah.
And without fail, the answer, I've showed up there because they've been underachieving their desired compounding path. And they're curious why somebody suggested they talk to me because I'm a tail risk guy and they're not bearish. And they're generally surprised to find out I'm not bearish either. I'm just there to say, you know, driving slowly isn't the solution. And so what has historically been the sort of practice version of modern portfolio theory is to just drive slowly, is to look backwards and say, over the last lap or two, the average lap speed that would have kept me from crashing was driving at 60% of my speed capacity. So I'm going to put 40% in bonds or cash or whatever and just try to target that average at 60% and hope I don't crash and that I keep up on average with everybody else. And that's obviously been a very poor, again, that's a recipe for what is known as volatility drag. You're always going too slow in the good parts and barely hanging on in the bad parts. And if your only tool to manage risk is to take your foot off the gas, you just end up going slower and slower and slower, and you become, susceptible to the siren song of the bear porn, I call it. You're busy collecting up bear trophies to take to the year-end investment committee meeting to explain why your mid-single digit returns was prudent in the third year in a row that equity markets are up 25%. And so, we pitch up and say, hey, here's the answer. Get some explicit risk mitigation and put more of your capital to work in things that participate on the upside. Things that aren't optimizing the Sharpe ratio and foregoing upside to reduce volatility so you can claim you were prudently taking risk. Let's go and put money in things that participate in the upside and stop paying people to take correlated risk with your money. You can do it for yourself. What you need is effective breaks, effective risk mitigation, so that you can confidently, plug your ears to the bearish siren song that rains upon you constantly. That's really the story that we tell every meeting we have. Take more risk.
So I want to bring Mark in here, but I want to go back to not to mix metaphors here, but the analogy that you gave earlier about forest fires. And all three of us, I think, interestingly, grew up in the Western United States, where forest fires are a big issue. In part because of a century of really poor fire management in the United States. This idea that, they should suppress fires immediately rather than have regular controlled burns to deal with the undergrowth that create these big explosive. That's effectively that analogy to leverage we were talking about before. You're going to get forest fires for all sorts of different reasons, but it's the buildup of undergrowth that creates these massive forests or massive forest fires. And I think Mark and I, in differing ways, but often on common things, see a lot of undergrowth in, I think, non-traditional areas. And when I've seen you talk in other fora, it seems to have been mostly concentrated in terms of, well, have we, burned out the undergrowth with the latest blow up in vol in markets or something like that. And we just had a year where, my top call last year was buy vol of vol. It was a pretty good call last year. But what does that mean now? Have we seen the undergrowth? And I think, Mark, why don't you take it over from here? Because I don't, I think that's the tip of the iceberg, frankly, in terms of undergrowth that we've seen out there.
Okay, sure. No, this is a pleasure to sit and listening to you guys. It makes me concentrate more than when I'm just watching passively one of your podcasts, David. I always enjoy these conversations. But yes, like you, I'm always focused on the underbrush and the forest fire too. That's why I named my Substack Global Watchtower because unlike my role before as running portfolio manager, I feel like the Watchtower's job is actually to assist a rational accounting man in surviving year by year by, pointing out where the small fires have struck, where the potential contagion is and where those lost campers are likely to be located, etc. So, we're watching the same stuff and maybe playing a different role. And I would say that, when I think about the financial market underbrush, I think it's all the things that you mentioned. Leverage is always the sure tail sign. Not understanding correlation, particularly across asset classes, always the sign of risk, etc. But in the business of catalyst prediction, I think that more than ever in the past, certainly, post-Cold War, we have this situation where the catalysts cross over from system to system, from either geopolitical risk system into financial markets or the societal and domestic political system into geopolitics and financial markets, blunting or accelerating the geo-economic strategies that are being deployed today. So I feel like the underbrush doesn't necessarily have to be in the same place that it has been in the past. And if I critique, the Trump administration last year in 2025, I would say that they came in with this aggressive agenda to address some of the underbrush, but maybe more so what I would call like structural underbrush. They immediately addressing, the global imbalances, immediately addressing, legal warfare and some of the domestic political issues that have become incredibly skewed. And they addressed some of the geopolitical risks, the low-hanging fruit out there, like dealing with Iran and Venezuela and underfunded defense budgets in NATO. And so I'm just wondering, did we do enough in 2025 in terms of controlled burns in some of these, peripheral overlapping systems to reduce risk for 2026? Or is the complexity risk rising and, we're getting to some tipping point in terms of a cascade from pushing too hard on a system with these kind of structural controlled burns? That's a big
That's
opening. Take it over, mate. What do you think?
that's a that's a big question. And you and I have talked about it before, and I've said, and Marvin as well. Obviously, he's probably written the most prolifically about this sort of Trump, whether it's a strategy or just it's the impact of injecting volatility into the system and pulling risk out of the system.
Yeah.
And it makes my job harder because the price of insurance goes up as the amount of risk goes down. So he makes it a bit of a challenge, gives me some sleepless nights when I'm concerned that, tomorrow or next week I won't be able to buy efficient
Hey,
convexity because
hey,
he's making it
Dave,
expensive.
as shocked. I don't know if you're as shocked as I am, but the price of vol has come down towards the end of last year and even into this year with Venezuela. I don't know.
Yeah.
I throw this into your broad to Mark's question. Uh, Is there a misnomer in market that somehow we have relieved some of that? Because it's
Yeah.
bizarre where vol is priced and where butterflies are.
So yeah, so I was going to say,
Sorry.
but despite those concerns, um, we have been fortunately able to acquire very attractive convexity, vol strategies across virtually all asset classes and across multiple geographies and different types of markets and different type of stuff. So, I guess in answer to the question, uh, the leverage in the system, and of course the way we see the leverage is through the selling of volatility through predominantly the structured product or the systematic vol selling type strategies that would indicate that there's plenty of risk in the system and that the cheapness of convexity across a number of markets and geographies is as good as it's ever been. And so it's a great environment for us. And, so I won't talk too much about specifically what we do, but it's been a great environment for our investors because they've had multiple years of really strong growth in their risk taking and additional risk taking assets. And we've been able, given the opportunity set that continues to come and go and then come back again, to construct, arguably the most potentially asymmetric protection we've ever had. And that's going over 15 years. So that means the environment's pretty attractive for finding ways to mitigate risk right now.
Interesting. And so, I guess like in the watchtower approach, I'm looking for the pockets of danger where the catalyst can potentially take place. And as you mentioned, there are always tell signs like, volatility and concentration of risk and that sort of thing. But what do you think about just simply shining light and bringing awareness to potential catalysts. Is that effectively reducing risk, or really nothing has changed unless the potential has actually been altered? So let's take a country example. In the world of doomsayers for debt market Armageddon, they look around which country has the greatest debt to GDP and looks to have a short-term funding crisis potential, etc. So let's watch that country. So everyone turned their focus to Japan last year with all the stress from Takeuchi's appointment and a sort of aggressive fiscal stance that she's taken. But with everyone having just combed through the Japanese story, understanding it from top to bottom, looking at net debt versus gross debt, and looking at how the rotation of buyers from the BOJ back to private sector balance sheets, like we saw pre yield curve control, etc. Is that enough just to shine awareness on it and get everyone on the same page in terms of assessment of risk, or do you actually need substantial reduction for it to be eliminated as a catalyst?
I think, and you guys know I've maybe been obsessed with Japan longer than even you two have, possibly, maybe just by a couple of years in Mark's case. But um, I've long said, I mean, this goes back years, that Japan, after 35 years of manipulating interest rates, of deciding that every borrower and saver, every importer and exporter, every speculator and hedger, every household, every corporation should have no say in determining the equilibrium price of interest rates, and only the Bank of Japan knows. And they would set it someplace, and the imbalances that will inevitably create, devil be your friend. And now we're in a world where they're trying to determine, the ability, the willingness and ability of the market to make some decisions around equilibrium pricing of interest rates. And that is obviously proven somewhat difficult of late, or well, really over the last 3 years, in the back end of the bond markets. And there's all
Yeah,
kinds of reasons why that's the case. And so far hasn't necessarily reflected in what to date are still very, very gradual adjustments and willingness to let go of the rate in the front end of the interest rate market. Now that's had obvious implications for the currency that everybody's well aware of, and you two have written about, beautifully for years. We, you know, the yen devalued 50, 60% over 3 years.
yeah.
A developed market, large global economy, major savings base, etc. So, that's obviously that had implications on the politics there as the
Mhm.
LDP got voted out again and again and again. But now somebody who's come in, Takeichi, and at least some of the measures that she has taken seem to at least reflect the voters' concerns on the impact of their debased currency and
Mhm.
the impact of the inflationary pressure. Now, whether that carries on now that she has the greatest majority that LDP's ever had, and she continues to use that to reduce the risk in the system and reduce the imbalances and progress forward in what I think is a fantastic opportunity. I think you guys have both probably heard me say before that, Japan reminds me of the US in the 50s, where Japan's somewhat unique in the world today. While it has, enormous, unprecedented government debt to GDP, has very, very little private sector debt,
Yeah.
much like the US economy coming out of the Depression and World War II, where all of the private sector debt had been wiped out and you had years of austerity during the war. And when the government started to crowd in to shrink back their debt and run financial repression, it created enormous growth in private sector borrowing and investment that led to many, many years of positive growth. Well, Japan could easily do that, but it necessitates that one tricky thing, backing off the government, shrinking the government. Now, this is something you guys have, I'm sure, heard me talk about or read me write about. I think the number one core underlying structural problem in the world is the population demographics. It is the declining working age population in most of the world's major economies. And I will argue that that has been the driving factor for the last at least 2.5 decades, if not longer, in much of the world. That defining where that largest population cohort was in a given economy, I call it the pig going through the python. Where was the pig at a given point in some economic regime, economic scenario? In the 90s, we're all very familiar because that was sort of, you know, the time of our lives when we were working together and doing stuff. The U.S. baby boomer population was at their peak earnings, peak tax paying, peak savings, and we were slowly wiping out all government debt because of that in the U.S. But Japan hit peak working age population in 1995 and has been fighting that battle ever since and continues to do so. And so I'm, adamant and very vocal, and obviously have spoken to people involved in these discussions in Japan, that Japan and all of Europe and Italy, that Marvin talks about a lot, is one of the examples of somebody who's maybe doing something about it. But the government needs to right size relative to taxpayers, future taxpayers. And if you don't think that's relevant, I don't understand how you're thinking about economics, because if there's fewer taxpayers and fewer savers, and I would argue this is a big part, Mark, of what we've seen in Japan, the Japanese retirees don't need 40-year bonds. And
Yeah.
the Japanese workforce doesn't have enough disposable income after 4 years of, what basically amounts to hyperinflation in Japan, relatively speaking,
Yeah.
and relative to wages. And they don't have the savings to buy any bonds. And so this transition away from the Bank of Japan carrying 50% plus of the total issuance by the government, and the government forever running super large deficits, deficits that are hard to justify outside of wars and recessions, creates this perpetual problem. And what Marvin mentioned earlier, my analogy of the Hunger Games, where everybody becomes a competitor in their efforts to issue bonds to ever fewer taxpayers. And
Mm.
that spins, now I'm really rambling, but that spins into a lot of the stuff you guys have talked about on your various podcasts, what some people refer to as the mineral wars, or this sort of security and defense buildup that's going on, where for, up until COVID, issuing bonds was easy because your central banks and regulated financial institutions absorbed all the bonds you could issue. There was no competition.
Mm.
Today, that's not the case as central banks try to restrain their balance sheet. We'll see how the Fed goes with their new guy coming in. And all of a sudden, France and Germany are competitors issuing bonds, and soon to be competitors with the EU in theory issuing bonds. And this perception that my friend Russell Napier talks a lot about, of capital controls and trying to trap savings. And obviously you guys spend a lot of time, or are in the UK, and Rachel Reeves coming up with all kinds of suggestions of how UK money and savings should focus on UK assets. And of course, everybody seems to endlessly be searching for new taxes to solve this problem of ever fewer taxpayers. So I think that's kind of the big structural issue driving fragility in systems. And then currency plays off of that. Uh, Equity markets and equity savings, and the imbalances of U.S. investment relative to domestic investments in portfolios where you have these mass savings, Australia, Korea, Japan, China. I mean, all these things I think are floating out there that represent, trigger points in a very fragile system.
I,
Mm.
I want to dig into some of those, but I'd like to sort of um, come back to this broader point that Mark was making about you know what defines undergrowth. And this kind of gets to that initial sort of pushback I gave to you at the very beginning about how we define risk versus leverage, right? Because leverage is, while I can create analogs in other areas, is really a financial issue. And so, I think one of the sort of underlying points about this undergrowth problem is that, and it relates exactly to your demographic issue, right? That is effectively a building of undergrowth. We have, and it's not just the West. You're now seeing this
Yeah.
across the world. I mean, even a country like Iran. Iran is now well below replacement rate. You go throughout the world, the number of countries that actually have a replacement rate population growth is diminishingly
Yeah.
small, even in emerging markets, right? So you have that problem. You have increasing social frictions across countries because of immigration, because of changes in our focus in terms of organizational structure of our economies and our societies. You have the entire problem of we constructed this, post-war liberal order that, as you both are aware, and as regular readers of mine are aware, you know, that all broke down beginning at least 30 years ago. And people are just now seeing it, and they think somehow Trump is the cause of this. No, Trump is the result of that, right? And so, how do all of those non-economic, which to exactly your point, you said this, you were clear on this, that how can you think about the economics without thinking about the demographics? But I would say that about the broader list, and how does that relate to Mark's question about last year we had a lot of financial market volatility that you might think cleared the undergrowth, but the actual undergrowth in the global economy in terms of those fundamental risks, I would say is massively underaddressed. And let me take this a step further to sort of lead this into a lot of those issues you raised, whether it's the Hunger Games in Italy, whether it's Japan, whether it's, Europe's broader problems. I'd like to throw China in there. You mentioned Warsh. I'd like to throw those in there because that's an area where you've talked about a lot. I would sort of divide the world into three camps. You don't have to agree with this, but I think roughly there are three camps. There are the arsonists who actually want to light that stuff on fire because they don't like the world order that we had and they want a different world order. So call it the Chinas of the world, Russia's to some extent, Iran, millennialist, stateless entities like ISIS, all of those. Then you have what I would call the irresponsible campers. And first and foremost on my list is Europe. People who just are totally unaware that they are potentially lighting a forest fire, just with their policies, what they're doing across the board. But you could also throw in technology, right? Technology doesn't try to create forest fires, it just does. It's just there. It is an unintentional fire starter. And then to this, we now have this new fire marshal come in, which, to your point, we don't know whether it's intentional or unintentional or otherwise. But he's clearly someone who believes in controlled burns and is like lighting fires all over the place. And I think to Mark's point, he's lighting social fires, he's lighting institutional fires, he's lighting geopolitical fires, he's lighting economic policy fires, he's lighting technology fires. He's going everywhere. And how do you have that enter this system that I would describe as full of all sorts of underbrush in all these different frames? So again, I'm throwing, like Mark did, a big picture, but I'm
Yeah.
kind of reframing and asking you, how do you look at the world in that context?
Well, that is a big one. Fortunately, from a business context, I just need to look at financial market risk. So we're focused on, you know, leverage on
But
where there's,
how do those connect, I guess, is the underlying.
yeah, I have a little bit of a view, which you guys may not necessarily agree with, but I have a bit of a view that economics is downstream from markets and that geopolitics is downstream from there. And that in fact it's not economies declining that cause markets to decline. It's markets declining that cause economies to decline. And that we've put so much emphasis since the Greenspan put era of using the wealth effect as the driver of economic growth and then having to prop up and sort of the moral hazard of forever bailing out the markets, that really the economy sensitivity now is to the market. And so a lot of why people say, oh, we thought there was going to be a recession in 22, 23, 24, 25, and it never comes. Well, it doesn't come because the market continues to support consumption, particularly in the US, but the world over, and that you won't see that. But that market, that policy of driving growth through the wealth effect of asset inflation has created this K-shaped economy or this wealth segregation contagion effect that makes the whole geopolitical, socio-political system so fragile, and has driven that it, I'll argue that it's exactly that wealth segregation that has driven Brexit and Trump and Maloney and Takeichi and this sort of populist movement the world over, trying to say, hey, knock it off. We want to get away from that ongoing process. And yet we find that it's really hard to get away from it, that even as the likes of Trump tries to throw some sparks into the forest to clean things up, he's fairly quickly putting the fire out because he's always concerned that something he can't control takes off. Now, I will argue that thing that can't be controlled is again the bond markets, the government debt markets. And so as we saw in March 2020 and then again in Liberation Day, everybody has to jump in and save the system when bond markets start melting down. They were happy to let equity markets melt a little bit. But once the bond markets get shaky, and again, this goes back to you guys have all heard me talk about my deja vu for that 95 to 99 era when US beta or developed market beta went straight up for 5 years as your hedge in you know global opportunistic multi-asset volatility paid off left, right, and center in the Asian crisis and LTCM and Russian defaults and etc. I got a big taste of that again back in Liberation Day when bond markets out here in Asia on a Monday morning got absolutely nuked. And you had 30, 40 basis points of steepening in bond curves in the morning. And then, Trump pulled the plug on tariffs that next day. Back in 1998, in and around LTCM times, you had a similar day in Asia, and you had the Fed do a between meetings rate cut that night to try to take the heat off. And so all these things, are going on all around us. And I think Kevin Warsh is maybe the most interesting thing going on right now because he's been very open and public about his displeasure with the mandate creep of the Fed and with its expansion into things that arguably go beyond the limitations of lender of last resort and setting overnight interest rates. And, most famously, I guess, him quitting in criticism of subsequent QEs and his very vocal statements that he wants to shrink the balance sheet. I look forward to seeing how he does that because I think so too. I wrote in one of my notes that in the review, the last policy review that they did, and you guys will know that I actually told this to people involved, that I thought they needed to remove flexible average inflation targeting and apologize for using it, and then explicitly state that QE is for emergencies only and should never be used again for monetary policy purposes, and apologize for doing it. Now, at least the only thing I got right was they removed flexible average inflation targeting, but there were no apologies issued.
No, and
I'm
I
still
don't
waiting for the apology too, mate.
Still waiting.
I don't think it will ever happen unfortunately, but I do want to press you on that point about Warsh because as you know I've written quite a bit about this that you know I actually expected him as the pick in large part because if you've been listening to the Trump team all along, they've been talking about deregulation. They've been talking about the balance sheet being too large. They've been talking about the Federal Reserve being too involved in the economy. And by the way, I just one little bit of nomenclature there, and you're not the only one to do this. It's my particular thing. Don't call lender of last resort operations QE. They're not. They have
No,
nothing to do with each other.
I agree.
Is substituting interest rate cuts
Yeah,
for balance sheet operations. That is what was the novel thing that
yeah,
Kevin Warsh complained about. He didn't
Yeah.
I
complain.
agree.
In fact, he was an active advocate for the
Yeah,
lender of last resort functions. And so to me, the thing that is most interesting, and this is really one of the things I most wanted to talk to you about here, is exactly this, because you, like me, have just been a vociferous critic of the Basel III Accords and how they have been a form of financial repression,
Yeah.
how they have actually built up leverage in the system. You talked about it earlier in terms of, you sort of implicitly described this analogy I've used about the little old lady who swallows a spider to
Yeah. Yeah.
swallow the fly that
Yeah. Yeah.
accidentally swallowed, and then she has to swallow a frog to do that, and so forth. And that's kind of been the way central banking has grown.
Yeah.
Well, we created this problem by putting these new regulations, so let's put more regulations to create that problem. And that's what's behind the growth of the balance sheet. You can't slim down that balance sheet unless you get rid of all of that
Yeah.
stuff. But this is the problem, is that, you know, we have 15 years of that now, Dave, and there are very few people left in markets who remember the old world. What's more disturbing is there are very few people at central banks. This is part of the reason why you won't get the apology, is because they actually don't understand that this is different, and
Yeah.
that the old world had advantageous figures. I'm really worried about. I am fully convinced they will deregulate. They will dismantle Basel III. The Federal Reserve has the authority to lessen all those thresholds to make this happen and thus allow them to slim down the balance sheet. But the things that worry me about that, and I think, you with your I buy vol signs, have a unique perspective on where we should be looking for things to blow up is one, the Federal Reserve Bank of New York does not have the staff to be able to do this anymore. Most of the bank treasuries out there do not have the staff to do this anymore. And if the US, the largest economy in the world, the most interconnected financial economy in the world, does this at a time when the heart of darkness in terms of undergrowth in the Basel III world, Europe does not, that seems like there's a lot of potential for train wrecks. Am I wrong? And where do you most worry about that path? Let's just assume that they are actually going to go on that path.
Yeah, I think that's a great thing. In fact, you know, anybody who saw me give one of my post GFC presentations, my presentation was, the cause of GFC, BIS regulatory capital guidelines. And uh, given the first time I gave that, the guy who spoke after me was the new head of the BIS, telling us why Basel III was going to make everything safe again. He wasn't that happy. And and so, in fact, I even take it all the way back to my demographics point. And I noted a G10 Commission demographics paper from 1998 that was supervised by my dear friend then at the BIS, Bill White, that said most of the stuff I keep saying about the impact of declining working age population, and not least of which being that productivity gains is the solution to the growth drag of declining working age population. What is not the solution is bringing forward demand from the future, knowing that you're going to have fewer taxpayers in the future. And then oddly, one of the obvious drivers of productivity gains is private sector investment. And so what would you like the banking system to do? You'd like the banking system to lend to businesses. But what did BIS regulatory capital guidelines incentivize all the banks to do? To lend against mortgages and government bonds. And so you look at banks. I was down in Australia last week, and you look at the big four banks down there. 25 years ago, they would have had a majority of business loans on their balance sheet. I mean, north of 50% business loans and the rest in mortgages. Today they're today they're only in mortgages and government bonds. The entire balance sheet. There is no lending for business in the banking system, and it's all been moved out into private credit and etc. So, you know,
Mm.
you can see where they create the fragility by creating the incentive to warehouse all this government debt. At the end of GFC, that there's only two big changes post GFC to Basel III guidelines, and that was the SLR, the supplemental leverage ratio, or the gross leverage ratio, that limited how many zero RWAs they could hold on the balance sheet, and then a risk-weighted preferential treatment to move risky stuff end capital owners so that you could take the losses next time. I was actually at a lunch where the Basel guy said that. And it was also at that lunch with the discussion around the gross leverage ratio, which basically worked out to be 3%. So you could only be 33 times leverage gross, where one of the very large global banks that had just been bailed out said, no way we could ever get down to that. Not a chance we could ever get down to 33 times leverage. But yeah, they were all given 12 years, I think, to get there. So I think most of them got there. And now, of course, they're going to have to remove the SLR. It's one of the big things that Scott Bessent and talks about in terms of freeing that up to try to get the banks to lend to businesses, right? They're going to try to figure out how to use the banking balance sheet again to try to address this productivity issue. Now, the only place that arguably that's worse is Europe,
Yeah,
where where
this is
there's
my
the
point.
banks the banks are only own government bonds. They hardly even own mortgages. They only own government debt.
And it's a completely bank-centered economy.
Yeah. Yeah.
Yeah, yeah,
There's no capital
absolutely.
market. There's no corporate bond market to speak of. So, yeah, these are all major problems and continue this path, the easy one to pick on. And you're always like I mentioned earlier, your foresights on Italy are fantastic because they're the one person doing something about it. But, France is a complete lost cause. I mean, the scale of their debt to GDP, the scale of their fiscal deficit overall, their primary deficit is the subset of that. The scale of uh, their role in the overall, the percent of GDP that is driven by G and C plus I plus G in France, the scale of their, you know,
Gee,
absolute maxed out tax take potential. It's hard to see where the solution is, especially if, the U.S. guys succeed in their ongoing efforts to weaken the dollar. Imagine France if the euro's at 135. Well, the last factory left is shutting down. That's it. You're done.
Mm, mm,
well, let's go. Look, I'd love more potential detail on like whether the basis trade or things like that are going to as we go. And if you have a quick thought on that's fine. But you mentioned this earlier, so I do want to pin you down on that. You mentioned your Hunger Games analogy, which if you want to quickly explain that, but just I and how that relates to the irony of the flip in Europe that everyone worries about Italian debt, but the debt is not the problem. It's your borrowing rate. And Italy is the only, well, one of the few countries in Europe, and the most important one, the only one of the big three, that has actually solved that problem. So, can you explain that and how you see that as an underlying developing risk?
Yeah, the Hunger Games very simple. It's just this competition to issue bonds into ever fewer taxpayers and savers, and that
Yes.
it literally now is a competition. And you can see something I've written about for January that to restore control of their bond markets, all of the major global central banks in 2022 eventually had to raise policy rate above 30-year yields. And then they held it there for a year. And then as soon as they lowered it below 30-year yields, the 30-year yield started going up again. So one of the things, Mark and I went back and forth talking about, who's to say that Japan doesn't have to do the same thing? Well, they have to restore stability in the bond market. Will the Japan policy rate have to rise above Japan 30-year JGB yields? I mentioned that with some friends that are ECB linked, and they told me that was ridiculous and crazy. And I told them I was going to dig up the recording of our conversation when they told me the same thing about the ECB in 2022, which they're supposedly even more experts on. So, but Italy, to your point, Italy through running primary surpluses in their deficit is reducing the rate of growth in their bond issuance. And nobody else is really doing that. And that's an enormous benefit. And thus their spread to boons has shrunk and France's spread to boons has widened. And that's going to keep going until somebody figures out how to fix France. Or maybe it'll narrow if Germany overtakes France in the growth of bond issuance, which they seem likely to do. So, it's a problem everywhere, and nobody has a solution. And as you mentioned, and we haven't really talked about it, China is the the poster child of the greatest loss of workforce, of working age population ever imagined. Not forget ever seen. I mean,
Yeah,
ever imagined. And this probably the greatest ever failing of central planning is the one child policy in China. And you
absolutely.
don't you don't need to have advanced math capabilities to figure out the consequence of that after two generations of one child policy. You have one grandchild for parents and two sets of grandparents. So there's one to replace six. And the acceleration of the decline in working age population there, I've regularly, linked a chart from the UN. They lose 600 million working age population this century, having
Mm.
brought on 500 million in the previous half century. Now, you can't help but think that bringing on 500 million and joining the WTO had something to do with global disinflation. I can't help but wonder if offloading 600 million and imposing global trade barriers and tariffs to try to correct accumulated imbalances over that period might have something to do the other way around with global disinflation. I don't know, but seems likely to me.
Uh,
Mm.
We've got about 5 minutes left, and I want to actually have Mark talk about some of the risks he's concerned about. But since you bring up China, I do, this is one that I have admitted regularly and publicly is one of the ones that most perplexes me. Is that from my perspective, it is absolutely clear that China is moving full steam ahead to take over Taiwan. Like in every single aspect of their military capacity, they are developing exactly the things in their accumulation of materials, everything. And yet, then at the same time, they had in these trade wars, which I know a lot of people will say the US capitulated on these things, and absolutely they had to, because China holds a much stronger hand
Yeah.
in terms of fundamental inputs into the US and global economy that literally would shut down the global economy within weeks, not months, weeks,
Yeah.
if China decided to. So why did China not more forcefully use those? It strikes me there's something much deeper. There's a really deep problem going on in China. Are you seeing something? Because that demographic problem you discussed is a critical problem, but it's a decade, multi-decade problem. What are you seeing now that worries you about China?
Well, for me, it's the same old, same old. I mean, as we mentioned with Japan, they manipulated the interest rate for 35 years, and now we're
And
trying to
exchange
figure
rate.
that out. Yeah, and that fed through to the exchange rate, etc. China's had a currency peg, in one form or another since I first went there in 1991. This is a story. I don't even, Mark may not remember this story. I got invited to go over and speak to the central bank in 1991 and gave a half-day presentation on, quote, what is an interest rate? Which the concept that and of course I led that off with it's the price for borrowing and lending, and the Deputy Governor Wong raised his hand and through his translator said, "Why do we need a price? We decide who gets to borrow and lend." And it's
There
not
you go.
things haven't progressed a whole bunch from there, but you've got sort of you know 25, 30 years of a currency peg while being part of the global uh, economic markets. You've got the uniqueness. I think what makes, in a sense, information so difficult is you have capital controls. So you
Yeah.
don't really know from the outside what's going on the inside because you can't see the flow and adjustment through the capital control barrier and what gets through and what gets out and what gets in. Now you can see that the FX reserves, which on an absolute basis seem large, on a relative basis, relative to the amount of renminbi M2 money supply that's been created in the last 15, 20 years, are tiny. Are tiny, tiny compared to the size of the domestic credit creation, which again dwarfs anything the world has ever seen. Makes both on an absolute and a relative basis the credit bubbles in Japan look tiny in the
Yeah.
80s. And so, now obviously they've been addressing that and they're going through a massive, you guys can talk, Mark can talk more than I can about the debt deflationary cycle that they've been battling for the last 3 years. And, as they kind of pick and choose which industries are going to go under,
Yeah.
educational technology and real estate development and, what's next. But meanwhile, they hold the currency flat where it is. They impose the capital controls. The however many people are still there, 1.4 billion people don't get to do with their money what they would wish. They get financially repressed at a sort of relentless pace. And, the things that they tried to do to circumvent the financial repression, predominantly lever r- real estate assets, have come back to bite them.
But yeah, the gold one is really like this is an underplayed story as to how much Chinese retail
Yeah.
was
Yeah.
levered to this trade.
Yeah, they have a funny knack there. They love the structured products there. I mean, remember, it was the Chinese retail structured products that were responsible for oil going negative in
Yeah.
2020. That's
Yeah.
retail people in China, the world's largest, energy market. So there's all kinds of stuff going on there that cause all kinds of wacky behavior. Sadly, not enough of it leaks out into my world where I can get my hands on it, but there is stuff going on there. These wealth management products, they call them there, uh, proliferated and people got suckered into doing the same things that goes on everywhere around me. The reason we sit in Asia because that vol supply still dominates out of Asia. Just is what it is.
Mark, any final questions from you?
Yeah, I would just say that in my watchtower role of advising rational accounting man, these big picture and often, as you mentioned, multi-decade, structural stories, they do produce rolling crises of smaller
Yeah.
magnitude in the year, and in advising and in forecasting and in trying to assist rational accounting man to finish the year alive. I do put some emphasis on this issue of bringing awareness to a structural risk as the first step, maybe in a 12-step program, but the first step in addressing the potential risk. And therefore, it is effectively a kind of a controlled burn. And so, in analyzing those, I'm constantly looking at where are the blind spots, where are the policy constraints, because that's where the little flare-ups are likely to happen. And when the crisis starts to unfold, big or small, it's always a relative game. So while, Japan looks horrific on the gross numbers, if I look at the policy decisions that have been already taken, now 2 years old, almost 3 years old under Ueda, and at least 2.5 years under the LDP through the last two prime ministers, they have started to push where they're at least forecasting a primary surplus for 2026. And we have the first thing Ueda did was eliminate yield curve control because it was the absolute, nuclear weapon. It was so much more destabilizing than QE or negative interest rates, etc. And now we have a normal shape yield curve, and we have something close to a value buy zone for long-term investors. And the investors may have to be all foreign investors because, like you say, the long-term duration buyers in Japan are dying out and going away. But it's not that big of a market. And foreign investors can bring a lot of support to it. And the BOJ is unwinding its balance sheet at such a slow rate that the handoff can be managed, if there is an exogenous shock. And Italy is a sign that, they create a model for the other Europeans to follow. And in the US, the changes under Trump and now appointing Warsh, you can see they're attempting to address the structural issues. It's just such early days, it's hard to bet on a winning outcome. So I'm very much focused on this cluster of controlled burns
Yeah.
that might happen in 2026, and I'm trying to determine whether the system can absorb them. Because if the system is robust enough, and we digest the rolling controlled burns in 2026 as well as we did the ones in 2025, then that's 2 years of decent progress towards reducing fragility. So I think that's the big call for this year. I hate the China risk that Marvin has flagged because that's a massive game changer. Uh, as a devil's advocate, I would suggest that you can look at China's buildup across the straits as their equivalent of peace through strength. By the preemptive buildup, you warn Taiwan to never attempt to change the status quo and make a move for independence because the threat is too large. So it doesn't have to imply war, and I think this peace through strength preemption is also a kind of controlled burn for the big Armageddon type of structural breaks. And so I'm not optimistic, but I'm at least happy to see certain countries making the right moves, showing the awareness of where the structural risk is, and taking those first incremental steps. And I'm willing to back a few of those stories in the markets for this year.
Yeah. As I said earlier, most of our conversations with investors is talking to them about their challenges and finding, uh, risk-seeking opportunities, finding good thin-tailed risk, places where there is natural volatility and they're getting rewarded for taking that risk. This is
Yeah.
particularly difficult if they are rational accounting man, because
Yeah.
their system tells them avoid natural volatility and go lever artificially low volatility. And in reality, if you want to create positive compounding paths, you should do the exact opposite. You should own things that are thin-tailed, that are paying you for the natural volatility risk, and you
Yeah.
should hedge with things that are fat left tail that attract leverage because in the Sharpe World, they attract leverage because they're low volatility and thus become left-tailed and become the risk to the system. But a lot of the things that have in recent years been thin-tailed. Tech stocks, growth stocks. Last year, a number of EM equity markets, gold, silver, copper. A lot of those things have had, basically exponential up moves. I mean, I've seen a lot of things in my life, and Mark could vouch for that. But I constantly put the Kospi chart on my screen and just shake my head at it because I've seen Kospi in mega bubbles, but I've never seen it go up like it has in the last 10 months. Nothing
Impressive.
like it.
Yeah, I think there's a rotation in EM out of China to anything non-China. And now, thanks to the Davos week, we have a little bit of a rotation out of US into anything non-US, non-China. So all of the what I call second tier markets that have a high beta to global growth, because we're going to get some synchronized global growth this year, have just gone through the roof. So South Korea, Sweden, Australia, South Africa, these countries are going to have to absorb a lot of more capital inflow than their markets can probably absorb. Uh,
Well, we're going to have to call it there because we're about 10 minutes over. So I'm going to call it and end there and really thank Dave. You have been incredibly generous with your time. We could, I'm sure, spend hours talking to you. Mark, thank you again. And we will look forward to seeing everyone in 2 weeks. Before we close quickly, Dave, any place that people want to find out more about convex strategies, and also, quick plug for your monthly investor letter, which really is one of the best out there, and it's free for everyone.
Absolutely.
So where can
Um,
they find those?
yeah, so we have a little website, convex-strategies.com, and we post up there a portion of the monthly investor letter that we send out, the bit that I write, we call our risk update, where we talk a little bit about what's going on in the world, but mostly about the math and science of growing wealth and about the simple mathematics of geometric compounding and some of the principles around uh, self-organized criticality and chaos theory and bounded rationality and ergodicity and some of the stuff that for whatever reason we didn't get taught in schools, but turns out it matters a whole bunch. And so it's a good place to go. And, we'll put this conversation up there and various other interviews. And so we're there. And I'm not as active as you guys, but I'm on LinkedIn at David Dredge and I'm on Twitter at Convexity Dredge. And every now and again, I might forward something that I thought was interesting, which is usually something I've written or something you two have written. That's about it.
Fantastic.
Well, great to catch up, Dave.
It's great to see you guys.
Thank you both, gentlemen.